Joining us more on the Fed and everything else happening in markets, Ann Berry joins us now, Threadneedle Ventures founder. Ann, what did you make of what we heard from Powell? What do you make of the market reaction today? Obviously, we've had a lot more in markets today outside of the Fed world, I think, is really driving the action. But as we sit here, pretty much now locked into waiting the next 6 weeks for the Fed to just get on with it. What were your thoughts on both what Powell said today and ahead of this? Did you feel like, July should have possibly been on the table for the Fed?
I don't think July should have been on the table. And what I heard was classic Jay Powell preserving optionality. We heard a lot of conversation, a lot of data, which basically points to this being a Goldilocks economy at this point. And they basically said it. It feels not too hot. It feels not too cold. We've got inflation coming down towards our target. At the same time, unemployment isn't, we're not hitting cliff levels in the labor market. So I don't have the same conviction that the market has that there is going to be a rate cut in September. I did not hear that there was a catalyst that would make that a done deal. I think we're still in wait and see. I think there's still a chance that we're flat in September, just as we were today.
So, Ann, your business has touched a lot of different aspects of the economy. Do you agree with the assessment that a hard landing is not in the cards and that this is a Goldilocks situation?
I do think a hard landing's not in the cards. And I think the big thing, Julian, I remember you and I talked about it last time I was on your show. We talk a lot about the headline rate, as we've done today. There's a piece of this that we don't talk about. And I want to point to an op-ed that Kevin Walsh wrote in the Journal, which I thought was phenomenal reading yesterday. We don't talk about the size of the Fed balance sheet, which is now north of $7 trillion. And the reason it has become so big is because federal spending, fiscal profligacy has been so enormous that the Fed has accommodated by buying a bunch of long-dated government bonds. So we haven't seen rates really come down as much as you might expect when it comes to long-dated treasuries. And I think as we go headlong into seeing what fiscal policy is going to look like for the next 4 years, Julie, I think that's the bigger concern right now. I think that remains, frankly, an inflationary pressure, and I don't see rates coming down yet as a result.
So in other words, you think even when the Fed does begin cutting, that, long and variable lags that we've been talking about on the upside for rates, forget about that. I mean, it'll be really long and variable lags because of that cushioning effect you're talking about?
Well, I think there's a couple of things, right? We're going to see continued inflationary pressure if we don't see fiscal policy get reined in. Over the longer term, we've seen this decline towards 2% now, but if we see federal spending bump back up again, or at least not come under control, if the deficit continues to expand the way it does, we're going to see upward pressure on inflation again, and as a result, we probably want to see that filter through into Fed policy again. So, I think the Fed's going to tread very cautiously at this point, Julie. If there are cuts in September, again, I'm not convinced there are going to be. I think they're going to be small, incremental 25 basis point changes as Fed Chair Jay Powell treads extremely carefully going into a new administration.
So, and I guess if you take all this together, it really seems like, in your view, the Fed has a much more challenging task ahead of it rather than just figuring out what the target range for the Fed funds rate should be. And I guess it would track then that, you go from, rates at zero, you raise rates most aggressively we've seen in 40 years. You're not just going to get out of it in, 12 clean months. And it feels like when you take a step back, the Fed is in a much more precarious position over the next several years than maybe the market's focus on, mid-September this year might otherwise suggest.
I think we've got to sort of ask ourselves, what are the cards that the Fed has got to play at any point in time? Right, it's got the headline rate, and it's also got the size of its balance sheet and whether it's shrinking or expanding its balance sheet, putting liquidity into the economy. If the Fed starts cutting now and we have another shock to the system, and we've had a couple, right? We've had the pandemic, we've had political instability. Who knows what we're going to have next? You kind of ask yourself, what levers has the Fed got left to pull? It does need to have some tools at its disposal to have some buffer in the case of exogenous shocks. Now, if right now we have this Goldilocks-ish economy, which they basically said in so many words in the presser today, it does beg the question, why rock the boat right now? Just because the market's expecting a cut doesn't mean that they have to deliver one. They have to keep looking at the data. And I think this is where, at least despite the criticism, Jay Powell's been extremely consistent. When and only when they see that 2% target right there on the immediate horizon, are rates going to start to move?
And I want to get into the market reaction that we're seeing today, which is very positive, especially among tech stocks. Now, yes, they were rallying before, but we saw them build on those gains after the statement and the press conference. What do you make of that reaction?
I think, Julie, when you look at how the market's tended to respond to the Fed comments in the past, it's always tended to hear what it wants to hear. Again, I remember you and I having these conversations where I'd say I'd find the market reaction to some of the comments by the Fed completely perplexing, even when the Fed has consistently said we're going to be data driven, we are probably not going to move rates yet. We've still seen the market have these little bursts of euphoric activity right afterwards. I think we're seeing that today. Right, the market is choosing to interpret the comments of the Fed as it being extremely likely, close to 100% by some predictive metrics, that there'll be a cut in September. And as a result, tech in particular, which is highly rate sensitive, is seeing a pop in prices today. Again, I'm not there yet. I wouldn't be surprised if the Fed doesn't move in September, and I think we get a negative reaction from the market then.
So then, Ann, maybe taking a step back from just what we heard in the last hour or so and looking at the market behavior really over the last couple of months in this rotation we saw in July. I think investors trying to figure out what the next leg of this trade is, whether it's an AI trade, whether it's a Fed-related trade. How are you seeing the landscape? And I think, of course, what was mentioned in the Fed meeting we haven't mentioned so far is this looming election risk, only a few months away here in the U.S. and how you've seen the market action, which, while to the upside, has been quite volatile over the last handful of weeks.
Well, I think the market volatility, Miles, that we've seen over recent weeks has reflected the volatility that we've seen in the political landscape, right? The slate of candidates that the United States thought might be up for the vote has changed. And as a result, you have seen the market perspective change. What does it mean if one ticket ends up in the White House? What does that mean for defense stocks, energy stocks, banking stocks versus another one which feels, perhaps more business as usual? I think one thing that is looming, Miles, and we started to see that change a little bit at the end of last week, and we're seeing it in both public markets and in private markets, is something you just touched on, which is the AI trade. I think we've seen huge AI euphoria over the last 18 months. And what we're now seeing, both in the venture capital world, where we're seeing a little bit of agita around whether there has been an AI bubble and people really beginning to hold their breath at valuations that have been coming out. I think we've been seeing it in the public markets as well. We saw it in the reaction to Microsoft. We're seeing it in the reaction to names like Meta and the anticipation around future earnings for some of these companies that have leaned really hard into what their AI story is supposed to be. The street's starting to say, show me the money. And if some of these tech names don't start showing the money, showing the profit coming from AI, I think we're going to be in for a bit of a rocky fall.
And do you think that those questions are justified? And are those conversations also happening in the private market between funders and founders, for example?
They're absolutely happening in the private market, Julie. There's no doubt about it. We saw really at the beginning of last year, end of last year, these young businesses which had AI articulated in some fashion, whether fleshed out with real specificity or whether just high-level buzzword hijacking, bringing AI into their stories, able to raise large amounts of money extremely quickly at very big valuations. And I think the private market has stepped back a bit and said, hang on a second, we're having slight 2021, early 2022 deja vu. We better really make sure that we're underwriting with the discipline that we should have been underwriting with coming out of a tough post-COVID capital deployment period. We're seeing the same in the public markets, Julie. Again, you look at Microsoft, look at the questions that are being raised around data center investment and whether that's going to pay off in the long term. So I think we are going to see a bit more rigor kick in. We're seeing it again in the private markets. I think the public market is a little bit overdue, but I think it's coming.
We'll wait for it. And good to talk to you as always. Thanks a lot.
Guys.